Good morning, Alex Cole. How are you doing today? Friday, March 26th. Welcome to a flight path review with GoNoGo Research.
Yep, let's do another one. I'm excited. It's been a pretty good week.
Been a pretty good week, and we're seeing some deterioration in the markets.
Yeah.
We start with a go-no-go heat map, just looking across the asset classes. Let's see if risk assets are still on for the stock market.
Absolutely. Let me share my screen. So here we go. We should be seeing my charts now. Let me pull up an asset class heat map.
Perfect. Now, go-no-go charts, right now we're looking at TradingView, but they're also available on wealth charts as well. Is that correct?
Absolutely. Yep. Absolutely. We'll go back and forth between the different platforms, but this is a TradingView heat map. Yeah.
Perfect. So what jumps off the chart to you here, Alex?
Well, there's a big bit of fishing going on in the top panel, right? So that's sort of the main thing that jumps off right away. The equity trends have been threatened a little bit. We're seeing those go fish bars on the very far right of the panel up here. Everything else is still in the same trend that it was in before. Maybe the treasuries, we're seeing the weakness, which makes sense, and commodities also weakening. Bitcoin weakening a little bit. Dollar, interestingly, strengthening, which makes sense with the deterioration in equities a little bit. But there's that amber bar coming in at the end of the equity panel that pops out to me.
And so we know that prices and yields move in opposite directions, with the IEF right there showing us treasury yields moving to a weaker downtrend, weaker no-go in pink. That means we've got some buyers of government treasuries. Really interesting week so far. Certainly not a market crash, a massive sell-off, but we are seeing some trend deterioration. And certainly as the market digests the amazing gains over the last 52 weeks, it would make sense that there's this cooling off period. Now, it just depends on each investor's objective about, whether this is a buying moment for them to add to positions, pulling out their shopping list for things that they wanted to get on the cheap. Or if you're a shorter term swing trader, this choppy market can be a real challenge. And we certainly, when we see deterioration like this, it's not reason to run for the hills to move your entire portfolio to cash. But we do know that the market can confound a number of investors. So we might be in a sideways choppy market for some time. So let's move on from the heat map and let's look at the equity sectors specifically. Let's focus today on U.S. equities. We'll look at the S&P 500 on a go-no-go rel map, showing us the relative strength ratios of each sector to the index as a whole. And look at that. You're starting to see some defensive sectors creep in. Certainly, profound outperformance by the cyclicals. But tell us a little bit more of what you're seeing, Alex.
Yeah, really exactly what you said. We're seeing a couple of these sectors creep in, utilities especially, just over the last few bars this week, starting to outperform relative to the index as a whole. So that's the first time that's happened, as you can see, in some time. You look at that lower panel, we've been in a strong no-go environment on utilities, which is obviously a defensive sector. When the markets are rallying strongly, that's going to get left behind a little bit. So interesting to see that sector especially starting to outperform relative to the broader market.
Absolutely. And so when utilities are starting to outperform, consumer staples joining the pack, these are very defensive sectors, which is not to say that you can't find leaders and laggards in each sector, but as a whole, allocations from large pension funds, big mutual fund managers, the ETF game is very strong in this market. So people are buying large baskets of equities, and an allocation that's sector specific makes a lot of sense for many tactical portfolio managers. And so when you see allocations, when you see trends picking up for consumer staples and utilities, that's a sign that the market's maybe undergoing a bit further contraction.
Yeah, certainly under a bit of pressure when you start to see the money flow into those sectors. That's a change that we haven't seen You look at in particular the fourth panel here, staples and the utilities down the bottom. We haven't seen strength in terms of outperformance from these two in some time. So that's certainly a change. And we'll see if that puts too much downward pressure on equity prices in general in terms of the market.
Absolutely, and the point of going through a flight path every Monday morning is just looking at where those trends have emerged and positioning accordingly, so that you're investing alongside the trend. So we wouldn't expect this to reverse strongly, but you never know in a very choppy market when things can bounce back. So let's move on from a rel map and let's take a look at Treasuries specifically. If you could pull up the 10-year yield, let's look at TNX.
Absolutely. Oh, can I make a comment on this while we're here, Tyler? What do you think?
By all means, please.
This is just the chart of the S&P, which was the top panel of the one before, but it was a little hard to see because it was the focus was on those sector maps. But it was interesting yesterday that this bar was actually a no-go bar most of the day. I don't know if you were following it.
I sure did. Yes, I was seeing some pinks and purples.
Yes, that's right. This was a pink and no-go bar most of the day. Rallied strongly into the close. So that's also another point to note, that we depending on your time frame, of course, but we tend to put a lot of emphasis and a lot of importance on the closing price. It's that price where the market has settled and the market has decided that's where we're okay to finish for the day. So it rallied strongly into the close. So that's a lot more bullish, or a lot more of a relief if you're still long the markets than if it hadn't. So we've actually now got one amber bar here, and we've had an amber bar before, and we've continued on. So I thought it was very interesting to watch that flicker between the no-go colors and then finish the day amber. So we'll have to see with the oscillator at zero where we go next on that one. But I just wanted to point that out because that was interesting to look at.
So you've got a couple annotations there on that chart, Alex. Sorry, let's drill into it for just a minute. You've got a trend channel on price. You saw some divergence between price and the oscillator, and then of course GoNoGo trend rolling over as the oscillator did. But we have not broken through zero. So what would you say to somebody at this moment, just in terms of what you would want to see from a constructive point of view to see that S&P trend move higher?
Yeah, I think that divergence is a fantastic concept, and it's something that's so researched, so studied, so looked at by so many technicians. But divergence does happen often in a trend. You could even see it here. We've got higher highs, and then you've got a lower high on the oscillator. So that'll happen. But when you combine it with this more severe corrective action that we've seen a couple of times now, that's why this one I've thrown on, because this is we also had this trend channel in place that we held for a long time. We broke out of it and we raced back into the trend channel, and now we've fallen out of it again. So are we breaking down out of this channel? We are seeing divergence again. We've highlighted that on the lower chart. Now we did have the last 2 weeks ago, we had this really up and down couple of days, which pushed the oscillator below zero, and it was able to quickly get it back above. So we're looking at the same thing here. This is actually nowhere near as concerning as it was 2 weeks ago. We're at higher prices. The volatility of the bar wasn't anywhere near as large. The trading range wasn't anywhere near as large. The oscillator has been pushed to zero, but hasn't broken zero. So, I'm feeling much better here than we were here, and we were able to rally and continue and actually paint a slightly higher high. But just by the look of it and the nature of the divergence and the fact that we're again now, instead of a string of solid go bars, we've had 3 amber bars coming in. We're back at zero again. It's sort of a watch moment,
Yeah.
It's an important juncture.
To me, the rotation into defensive sectors maybe even more telling than the price action itself, right? That we're looking at the behavior of investors. That's what a price chart will show for you. And so to see allocations to more defensive and cyclical sectors, it's not a bad thing, right? Rotation is the lifeblood of any bull market. But yeah, let's move on from the S&P and take a look at the treasuries that certainly newscasters have been blaming for recent volatility. And just a quick point to all of our watchers: treasury yields have moved higher, but they are not high. 1.6%. When you're looking at a long-term average, we are still extremely low. And if you pull that out to a monthly chart, for kicks, there's the weekly, right? That was the peak low during the coronavirus pandemic sell-off. But when you look back multiple years, we are at the very bottom of a long downtrend in treasury yields.
I mean, this was 1982, 16%. I remember my dad telling me about his mortgage rates when he bought the first house. I'm like, geez.
For the older generation, I remember buying my first house in grad school, and Grandma just said, "Well, just make sure you pay it off as fast as you possibly can."
You're like, why? It's cheap money.
Grandma, it's 2006. I don't even pay anything but interest on a mortgage, and it's 5-year adjustable rate. I was part of the bubble, but needless to say.
No, but I mean, even now, you refinance a house at 3%. You're consolidating
totally
loans into healthy, very controlled interest rates. You're not paying 15 to 20%.
Exactly. For everybody in the United States and in developed countries, that is an incredible luxury to have access to capital at low rates, and we're spoiled for choice when it comes to how we structure our debt. For people outside frontier markets, you see currency fluctuations and interest rates that spike, and so a lot of things are paid in cash. But that's a story for another day. Let's talk about the TNX, Alex.
Yeah, so this one we highlighted it obviously in the flight path. I believe we were sort of right up here, and we were overbought. And the question is it the speed of rising rates that's spooked the markets a little bit, right? Not the actual rates themselves, because like you said, they're historically so low. So I think that there's a bigger case to be made that it's just the speed of rates rising. But then we had the Fed, continuing to say that inflation wasn't going to be a problem. Rates aren't going to rise for a couple of years. So the rates have fallen back this week. And I think midweek we did a little update where we saw if I zoom in a little bit, we saw this short-term counter-trend correction arrow above the TNX. We noted that it might cool off and come back for a little bit, and we were wondering how that would affect equities. So still obviously in a very strong trend, but oscillator at 0. We watch to see if it bounces again for rates to go higher.
Wonderful. Yeah, just an incredible trend, incredible price thrust when we're talking about yields on the 10-year. But certainly it would make sense for a period of consolidation after a move like that. And I think that for most investors, a calmer U.S. Treasury market might make for a more accommodative equity space.
Absolutely. Yep.
Well, we looked at that on the weekly, monthly, and daily basis, so everybody can have some perspective on where rates are. I think that's often lost when we're looking at financial news media. But certainly, a rapidly increasing yield on treasuries brings into question the valuations on a lot of technology stocks, a lot of these companies that were stretched in terms of their PE multiple. And so that cooling off period for U.S. Treasuries may be more accommodative to the equity space.
Absolutely.
Let's switch over and take a look at the energy sector for a little bit. We've seen huge moves in oil, and obviously the equities that follow U.S. oil have not been in lockstep. But let's take a look for investors' sake at the XLE. And just see how that trend has performed through this week.
Absolutely. Yep. So let me know if you can see. If you
We sure can.
Okay, here we go. Let's put in XLE here. Now we've switched over. We're using wealth charts chart. Let me just XLE. You said
XLE.
All right. Let me just do that again. I think I put in XLF.
We'll look at that in a minute.
All right. 1 second. There we go. Okay, so this is XLE.
Perfect. Looking at it on a daily basis.
Yep, daily basis, XLE. I can make the chart bigger for you. There you go.
Thank you. Yeah, perfect. Looks like we've had a pretty sharp period of consolidation this week for the energy sector as a whole. What jumps off the chart for you, Alex?
Yeah, and I think that you mentioned in the weekend write-up for launch conditions, or maybe beginning of flight path, that energy had lost over 7%.
U.S. oil sold off nearly 8% last week on Thursday.
Right. And we've seen the trends in oil really contributing to this. But yeah, so this is again, you pull it back, you look at the trend. It's been in place for a long time. It's been driving commodity prices higher, but you had these warnings. We had the counter trend corrections coming at the top of this last move where we had overbought on the oscillator. We saw then the oscillator come back to zero. We noted, would it hold here? It didn't. So we've gone back below zero on the oscillator, which shows that there is some bearish momentum. There is there's enough inputs to the GoNoGo oscillator that have actually given us some oversold readings. Which is a little bit of a concern for the trend. But I would point out that this has been sort of the MO of XLE during this trend. The corrections have pushed the oscillator below zero to about 2 or 3, and then have rallied back strongly. We haven't had any change in trend color. So we'll see. I think that it's still, I would look at this as still in its trend. It's made a higher high. The low here is arguably still the higher low from this higher low. And so, we've also very quickly, after breaking through zero, we've come right back up towards zero on heavy volume as prices stabilized. So trend is, the first thing you look at, we're still in the go trend. We haven't fallen out of trend colors.
I think that that's a really healthy reminder. Sharp or accelerated profit taking at peak levels, pushing that oscillator below zero, where you see a lot of selling, a lot of profit taking, not just for the XLE, the energy sector, but across the equity space. That can be really healthy for the duration of a bull market, right? We've seen a lot of analysts talking about the signs of this being very early innings in terms of breadth, in terms of a lot of momentum thrust, that momentum waning, and seeing the a lot of profit taking. Really, as a contrarian, you don't want to see those signs of euphoria that come at the end of a bull run, where everybody believes the market goes nowhere but up, and they'll buy anything at any valuation, at any price. I think it's pretty healthy to see that, at least on the institutional side, we're seeing some portfolio managers, reconstruct their portfolio here as we're coming into the end of the first quarter, maybe taking some profits at these levels on behalf of their clients, and reallocating to a few of the defensive sectors, and even in the energy space. I think we moved pretty far, pretty fast. So let's move on from the XLE and jump into SunPower Corporation. That ticker is SPWR. And let's see how the trend played out this week.
Yeah. So SunPower, we were looking at. This is the daily chart. This is actually sort of the same, interestingly, very similar shape or similar price action to some of the technology stocks that we've been looking at. And we saw. It's a very, very nice chart from a GoNoGo perspective. We saw the breakdown below zero. This was a long squeeze riding the zero line. If we had the squeeze indicator on here, you'd see that. Then it broke sort of fell out of the go colors, went into the no-go colors, and has now been really moving sideways. But we were looking at this to see, would it, based on some bullish divergence, would it be able to break back above the zero line? Would this be a short-term no-go move in a potentially in a larger go trend up? We haven't quite had that yet. We haven't had that follow through from the oscillator getting back above zero. So we've seen it test the zero line a couple of times, but we're still right at that zero line. So it'll be interesting to see whether the no-go continues or whether the oscillator breaks back above zero and leads price color change in the panel above as well.
Well said. And I know for subscribers to GoNoGo Research, when they got Flight Path on Monday morning, we were comparing that daily chart to the weekly chart of SunPower, and that multiple time frame analysis. For anybody who is looking for a great course of study, you should pick up Brian Shannon's book, Technical Analysis of Multiple Time Frames. It's a great approach to understanding how you would see things across maybe a larger picture view, and then drill into the smaller time period to actually place trades. Now, Brian's working on a much shorter time frame than what we're showing here on these charts. It's not dailies, weeklies, and monthlies, but intraday and intra-week swing trading. So on the weekly chart here, Alex, we're still in trend, and you're seeing that oscillator at the zero line. Perhaps a move back to prior highs would give investors a real leg up.
Yeah, and this is exactly what you're looking for if you're looking at that sort of multi-time frame analysis. So the reason we pulled out that I wasn't clear enough, but the reason we pulled out that daily chart was to sort of along the thought process would be that if that was a short-term no-go within a larger go, that this is what we're looking at now on the weekly, then we are looking for an opportunity, perhaps the first sort of bullish go signal or the bullish signal to get into the longer term trend. And so this is the I think I just said longer term friend. I do think of the trend as my friend. So
the trend is your friend until it bends or ends.
This is the long term friend, that's been around for a while. You know him well, you trust him.
Anyway. Hey, Alex, it's Friday morning before the sun has come up. We've still got one more trading day this week. Don't you worry.
So anyway, my old friend here, the weekly SunPower chart. It is a go trend. We've had a massive rally, from below $10 all the way up to 57, and we've come back, right? That's a lot of profit taking, but on the weekly chart, that's caused it to hit the zero line and ride the zero line. So now if you're somebody that's looking to perhaps potentially get into a position in SunPower because that's your view, your longer term view, you then maybe drill down into a lower time frame. Mm-hmm. And that's why we had the weekly on here, and then the daily then shows you what to look for to then perhaps enter that trade. So this isn't saying go long now, but what you have the beauty of is sort of looking at this and saying, okay, my longer term perspective is that I do want to maybe get a position and enter a position into the longer term go trend. So I can look at the daily chart now and wait and see if this no-go continues, gets rejected by the zero line, makes a new leg down, then we've been saved a lot of pain by not getting in at that point. But if we rally above zero and then we get a new go signal here, maybe as an investor in SunPower, we're saying, okay, now's a good time to get into that trend that I saw on the larger time frame.
We're certainly seeing the lower highs, but higher lows as that starts to squeeze in its price range, and potentially looking for a bit of a breakout there.
And the lines that were on here were what we saw, earlier on. But now we can extend those out, and we can see, we're getting those higher lows in the oscillator as well. Converging around the zero line. Lower highs, but higher lows, so some sort of perhaps pattern. You could be looking at a pattern breakout if you're considering this to be some sort of triangle on the price panel as well.
Absolutely. All right. I know you wanted to get to it earlier. Typing in XLF for us. Let's take a look at the financial sector's performance over the week. And so this is the S&P financials sector XLF.
XLF. Yeah, another great one. We've seen a strong performance out of the financial sector. You can see that highlighted on that sector chart. It's been an outperformer now for a few months, and we're a lot of things corrected. I think that's sort of the theme to this. A lot of sectors, a lot of charts, a lot of stocks came back over the course of the last four or five bars. But interestingly, the financials then popped a little bit and have gone higher, and we're still riding that zero line. So nothing really to worry about yet in terms of financials. We're in a go trend. Price seems to have set a higher low, right? So this action here has caused this to become the low. We're at the zero line. We're riding the zero line. We may well be looking now at price trying to set a new high.
Yep. Today's trading will be very telling in terms of a close for the weekly. And again, next week we'll see a close on the monthly charts for that even bigger long-term perspective as we're coming to the end of the first quarter for 2021. And these are important tells about where investor mindset is at and where we can see more constructive go trends throughout the U.S. equity market. So as is common with GoNoGo Research, we're looking from a top-down perspective. We're looking at that weight of the evidence when we're going from asset class to sector. Now let's drill into a single security. Let's look at Ameriprise Financial just to see how this is performed on a single stock basis.
Hate to be boring, but it's moved sideways again. It's done much of the same, which is okay, because to somebody looking at this, that's the consolidation sideways. The longer that goes on, the more likely some sort of move might come out of it the other side. So I believe we were in here on Monday, and we've really moved sideways, and we're not much different in terms of closing price where we were when we highlighted this chart in flight path. But go trend in place. We've seen the counter trend correction arrow come at the top that sort of caused this short-term consolidation correction sideways. Remember, corrective action doesn't have to be down. Corrective action can be sideways. So that's an important point, I think, as well. A lot of people don't realize that corrective price action can be a consolidation sideways. It's just shaking things out or correcting what's happening in the trend. But we've seen these multiple low risk entries here. So this would still be in play if you'd seen these. We aren't lower than the lows of this period. So these were low risk opportunities, go trend re-entries that we saw towards the right side of this consolidation. Nothing's really happened. We're still sort of moving sideways. But if you consider some of the charts that really came back over the last 4 or 5 days, this one really hasn't. So maybe that's some strength there. Oscillator's really been at zero and trying to find support there. It's been at zero for a long time during this consolidation. So this one's still very much in play in terms of what might happen next.
And in your opinion, the longer that stagnation, where there's no control decisively from buyers or sellers, from bulls or bears, when it does finally break out of a long-term sideways consolidation, the technical textbooks tell us that that's a continuation, that we're likely to see it move in the direction of the prior or underlying primary trend. Which I think is an important point to note. It's frustrating, no doubt, for investors who were, experiencing incredible trends over the last 52 weeks. But we may be in this sideways, choppy market for a time. That doesn't mean that that it's going to end badly.
Yeah, and I think that what you mentioned at the beginning of that was just that the longer the consolidation happens, that stagnation often leads to a move. And so that's why the GoNoGo squeeze was developed, to try to highlight those situations where price was moving sideways or was volatility was shrinking. And you can see on this chart a couple of times the squeeze has built, and then you see a nice run out of it. This was a lot with it, really good squeeze, climbing all the way to extremes. And then this sort of fluctuation around the zero line has broken the squeeze. But imagine that squeeze really is continuing. We're still at that zero line. It's trying to build again.
That looks like the way I get out of bed. The alarm goes off, and yes, I am awake, and it's time to get up, but I'm really not committed to the idea, and I'm still on my pillow.
Yep,
that squeeze continues.
So really, this is just there definitely is that idea that the textbooks will tell you, and that's what people look for. The longer there is reduced volatility, the more likely the move that comes after will be significant. My old buddy with the toothpaste analogy.
Mm-hmm.
It's like that volatility being squeezed, and then something will happen at the other end. So it's still definitely one to watch. We may well get another low-risk trend re-entry here if price moves a little bit higher. So as I've said before in other videos and other places, I love to see multiple low-risk entries coming towards the end of a consolidation. That often indicates that the strength of the breakout might be good. So.
Brilliant. Well, Alex, this has been a pleasure this morning, Friday, March 26th, to review GoNoGo Research Flight Path with you. And thanks so much for the insights. Good luck out there. Safe trading today. And we'll talk to you again real soon.
Thank you very much, sir. Speak soon.
Bye-bye.
See ya.